As you just heard, we're going to be looking at the financing challenges throughout Africa's commodity supply chains here, but also looking at some of the global issues that are very much at the forefront of the news right now. I'm going to very quickly introduce our panelists. You'll see we've got someone joining us remotely, and I'll be introducing Rahul in a minute. But in no particular order, we've got on our panel today Rupert Cutler, who's a risk insurance consultant with Holtarka. We have Dheerie Govender, who's the Chief Executive Officer of Global Collateral Control. We have Stewart Makura, who is the Sub-Saharan Africa Head with Citi. Jesse Chenard, who's the Chief Executive Officer and co-founder of Monetago. Krishnan Nagendran, who's the Director of Ducat Maritime, also being mic'd up at the moment. And last but not least, joining us remotely, we have Rahul Rastogi, who's the CFO for Africa and Mena for cocoa beans of Olam Food Ingredients. So welcome to all of you. We've got a fairly packed set of topics to get through. I'll be fairly strict on timing, and hopefully we'll all get away to lunch very swiftly. I'm going to go straight to a question that just came up at the end of last session. Of course, it's what everyone is seeing on their news screens at the moment. And the headline, Russia's invasion of Ukraine leaves global trade in tatters, is not what we were thinking we were going to be talking about when we were all physically here 3 years ago, let alone even last year on a remote basis. And in addition to the absolutely appalling human cost, and I think many of us know people directly affected there. I've been in contact with people in the Ukraine over the last few days. Absolutely terrible situation. But the ripple effects of the sanctions imposed, including the measures against Russian oil with the US, immediate ban, the sort of more staggered approach of the UK and Europe, are really being felt everywhere. There are oil tankers, bulk carriers diverted from the Black Sea. Many of them are stranded, Russian bank assets frozen, SWIFT unavailable. Even the English Premier League is now affected as of this morning. I think you know what I'm talking about there. But I want to know from our panelists how this crisis and the range of sanctions is impacting your business, either directly or indirectly, and how do you see that impact increasing over the coming weeks and months? And Rupert, let me come to you first.
So the way we see it happening is that the sanctions aren't going to stop quickly. So the first time Russia invaded Ukraine, the insurers waited, paid up for losses. But we're now talking not just about political risk, we're talking about property, aviation, marine. And everyone's concerned what they're going to do with valid claims if they can pay. But equally, what's going to happen on the trade? And one of the previous panelists mentioned grain. I think people don't realize that, for example, Egypt gets 60% of its grain from Ukraine. And if you're fighting a war in March, you're not going to be planting any corn. So it's going to have that impact on all of us. And it's putting costs up. So that's the first impact which I would mention, Robert.
And is the insurance market, waiting with bated breath to see what's coming through in terms of losses? We heard from the previous panel that obviously there's a lot of stuff out there waiting to emerge.
They will be waiting for the losses. Some of those will be recovered. Some of the goods that aren't being shipped will have to be shipped at some stage. But everyone hasn't really worked out, because we've never had a situation where the whole world has basically tried to close down a country, with a few notable exceptions, as to actually when it's going to get back and when the trade flows are going to continue again. But the economy of Russia, although it's causing major effects here, is only the size of Spain. I'm not being anti-Spanish, but it's not as big as everyone thinks. So it's part of planning to adjust what you're doing despite the tragedy that is going on at the moment.
Stewart, what's the mood at Citi in relation to this? Is it what everyone's talking about across the virtual coffee machine?
Yeah, I mean, look, certainly the conflict has become center stage for us. We have pretty significant, sizable business running in both Russia and Ukraine. Just yesterday, I was chatting to colleagues who are being repatriated out of Ukraine, trying to find some refuge in Warsaw or in other places like that. So there's a real human element to it that I'm getting connected to. And beyond that, the level of disruption that's coming through the various sanctions that have been imposed on a number of players that operate between Russia and the rest of the world. And we have to make payments. So all of those things are having to stop midair. So there is just a huge amount of disruption. We've got people on the phone. They're going to find out what's happening with the payment. Why is the payment not going through? Okay, so what's going to happen next? Even we don't know what's going to happen next. All we know is we have to stop payment. And then this situation is evolving over time, in terms of what are we going to do, and how is it all going to play out? How are our clients going to be able to repay some of the open positions they have with us? In addition to that, the conflict itself is leading to a lot of volatility, particularly in the energy sector. And that volatility in the energy sector is pushing up the need for working capital from a lot of our clients. And it's putting quite a lot of strain on the system, having to reevaluate exposure limits to energy, for example. If we got enough, are we being overexposed? But what do we do to continue supplying our clients that now suddenly need to pay 40, 50% increases in pricing? So the repercussions are really widespread.
And those lines being soaked up very quickly with that price volatility. Rahul, let me go over to you. Rahul's joining us from Côte d'Ivoire. How are you seeing the situation in Ukraine impacting you, either directly or indirectly at the moment?
So we are adjusting on an hourly basis actually to the sanctions all across the globe. And we need to adjust our supply chains majorly basis that. The prices of commodities are on the rise. In fact, I think we have spoken about grains anyway, 30 to 40% increase globally. But my surprise came because even the comfort foods such as cocoa and coffee are also seeing a jump back, which was quite unique for us. Along with that, the freight, which are already there 3 times, are now increasing even much more. So which probably puts a very strong, you can say, focus on the working capital with higher prices. And we are seeing now a very, you can say, combined effort to try and see how we can manage supply chains from a different level altogether. So even the grains across or other commodities, we are trying to see how we can just maneuver across and still continue with our capabilities. So we have a business in Russia, but thankfully it is not that big as of now. But we really hope that the effect that Russia and Ukraine is having on Africa is really subsiding down slowly and slowly, hopefully.
Thanks. Jesse, how, from Monetago, obviously you're at the sort of cutting edge of fintech finance. Is this exactly the kind of situation that organizations like yours were made for?
Well, yeah, I think it's interesting. We don't do a lot of business in Russia directly, but the global banks that we work with and what have you have obviously been impacted. I think that the push towards digitization, the push of technology is going to help with the sanctions. It's going to also exacerbate the situation, I think, as well, because you get that much more visibility into what's going on and how it's being controlled. It's very interesting to see the world cut off a country like this. We just went through COVID where we all just cut off from everyone, and now it's a very unique situation where technology is definitely playing a role in enabling these sanctions, and I think you're gonna see an impact again, just like we saw with COVID across the supply chain, and then even things like some Russians who are stranded outside of the country right now. The impact for them. I live on an island in Thailand, and there's a bunch of Russians there. Their cards don't work anymore. The value of their money's gone down, and so it's not just on a supply chain level, but also on a personal level. It's really impacting people globally. So yeah, it's quite a tragic situation.
Krishnan.
Well, I think there are. Can you hear me? I think there are a couple of things that immediately come to mind. The first is, look, global trade is all about creating an equilibrium between trade flows from different geographies in the world. So, because the Black Sea has been shut down, we're finding that on the shipping side, you now have a disequilibrium. And unfortunately, now you have the pooling of vessels that you see in the Black Sea and Mediterranean, and they're not going to the destinations that they would normally go to for redelivery, for goods to come back in and out of Africa. So I think it's too early to say what the new equilibrium is going to look like. I think it's too early to say whether or not certain countries are going to rebalance trade. But clearly the situation is extremely stressed. And I think that in particular, in light of what happened in 2020 and 2021, we're going to find that the logistical supply chain pressure, in particular in Africa, is going to be stressed for the big imports and exports at a time when people probably can't afford it. And I think that's something that we're all quite conscious of. But on a positive note, Africa has obviously been the subject to a number of natural disasters, political instability, and somehow we've always managed to find a way. So, that's the upside.
A direct or trickle-down effect that you're seeing?
I think the last thing for me to say is, from a South African perspective, we're reliant on Eastern Europe, and particularly Russia, Ukraine, for fuel, wheat, and fertilizer. So we haven't seen the impact thereof as yet, but from a physical perspective, but from a market perspective, you can see it. I think wheat is at a 14-year high. And the ultimate cost of that is going to be borne by us, the consumers. And I think that impact is still to be seen.
Thanks very much indeed. Let's go back off that subject. 2021 was a pretty extraordinary year and saw some quite different sort of financial outcomes in international trade, depending on whether you were sort of multi-banking, tier one international energy and metals trader or an SME. So banks retrenched pretty heavily because of things like frauds in Singapore and elsewhere. But the big beast traders had a fantastic year, whilst others struggled to do business during lockdown and travel restrictions. And obviously with the increased pressures and the stress that you're just talking about there, how are is the global supply chain in 2022 going to work out? Will lenders be open for business? Or will traders suffer even more in trying to get access to liquidity? So Rahul, I wanted to come back to you on that one, if you can, in terms of how you see the supply chain, working capital and so forth affecting you and your organization as a trading company.
Definitely, that has been focused on for the entire last year as well. Definitely liquidity is also squeezing out, and we have seen a lot of impact not only on us. We definitely had a good with, as we said, the big trading houses. But at the same time, we also saw quite good market for our competition for even SMEs last year, who had done the business consistently. So that is something which was important. And last year, towards the second half, I think Africa was one that was affected from the pandemic from the health side, and they were recovering back with vision by the various markets and the government. That really helped them to probably get access to liquidity, which I have seen in multiple of our countries from them. I think the current scenario that we are facing, and coupled with the coming up of from the pandemic, I think government will have to infuse a bit more onto that. But with the current debt GDP ratios of various economies onto a downside, it is really difficult. It probably will have to be a handshake between the big players, the banks, and the SMEs. In fact, as we speak right now, there are a lot of SMEs, a lot of our allied players that will work with us. We are trying to work with the banks and the financial institutions, however we can probably back them to probably help with the liquidity pressure that we are having. I think unless there is a really strong, coordinated effort towards this, I don't see them really managing it out. But yes, definitely, I can see the next year really hard in terms of the liquidity and the working capital.
Thanks very much, Rob. Dheerie, how are you seeing this year panning out in terms of not only yourselves, but of course the customers that you're dealing with?
I think our earlier panelists touched on that in the sense that COVID first brought a knee-jerk reaction, I think, which was followed by the amount of fraud that you saw in the industry, the insurance companies and the banks. And everything came almost like, and then a lockdown. You couldn't move, you couldn't take care of things. So I think the entire situation was exacerbated by all of these events. I might be a little bit liberal in saying that we kind of understand the demon that we're dealing with, and we're seeing a change. I know a lot of the financiers are talking again, speaking to clients. Of course, they're going to be very particular and meticulous in the type of clientele they're onboarding now, but there is some positive for sure.
Krishnan, is there a sort of them and us position, but that the have and have-nots in access?
Yeah, look, I think there's clearly a bifurcation in the market, right? So for a trader, volatility is basically how they can make money. So clearly 2020, 2021, and what looks like 2022 is going to be fantastic years for guys who trade essentially on volatility. And by volatility, I don't just mean price volatility. I mean the ability to make geographic arbitrage or legal arbitrage across different regions. For SMEs, in particular industrial SMEs, the scale of volatility, I think, is an existential threat to them. And I think in particular because the access to finance, in particular the lack of access to finance by, let's say, local banking structures, simply isn't there.
Good. Jesse, I want to come to you on a different subject, and that's something you touched on a little bit earlier when we were talking about how organizations like yours and the technology is actually going to mean that sanctions can in fact be a lot more effective than they were sort of 15, 20 years ago. But some of the root causes of blockages in the international money supply are sort of rooted to KYC and all of the compliance paraphernalia that people have to get through. That's always been a brake on the agility of lenders to get deals through credit. Very often the number one thing that they would quote as the reason why they're not able to be as nimble as non-bank financiers and other platforms. But right now, compliance departments across the board are obviously sifting through, trying to find out who the UBOs are of organizations that they thought ostensibly were Swiss or other origin. But is 2022 the year that we see a lot of international trade business simply risk managed to death? Or people going to adjust their operations to get over that compliance hurdle with your help?
So, I think compliance is always an issue, especially at the lower end of the market. And I don't think many banks have really overcome that issue, and the current situation is just going to continue to exacerbate that. So, big traders are going to be largely unaffected by it. There's that flight to quality there that we've seen during the COVID pandemic. I think because compliance is usually so removed from the business, it's easy for them to say no. So I think we're going to see, as Krishnan said, sort of a bifurcation of the market here, where the big people are going to be just fine, but the compliance department and the risk management people, they don't get fired for saying no. So it's going to continue to be a hurdle. Again, technology will continue to help enable this, but yeah, it's without markets that have sort of institutionalized KYC, like in India with the TREDS exchanges and what have you, it's difficult for that lower end. So we're going to, I think, continue to see those compliance issues and risks.
Stewart, every bank GC I know will say that even before this situation we have now, something like 80% of their time was taken up with sanctions, compliance, KYC type issues. How is this affecting daily operations for you? Has it tightened everyone's focus across the board, not just on Russia, but everywhere, to see what's lifting the bonnet and seeing what's underneath in the engine?
Yes, certainly. I mean, it is crucial. Before you can deal with anybody, you've got to tick the boxes on that particular counterparty. And for me, this issue of KYC takes two. There are two main aspects to it. There's the regulatory aspect, so you've got to comply with the regulation and the law. And be able to know who you're dealing with, be able to identify them and to ratify that identification. Then there is the other part of the KYC where you really need to know your customer's business. And a lot of that becomes part of that due diligence. And a lot of banks and institutions out there have come up with target market criterion. And it takes a lot of work to go through and making sure that whoever you're dealing with meets the requirements of that target market criterion. You know, do you know their cash flows? Do you know the source of their information? Who are their auditors? Is it a company you can rely on? Do you need to invest more in investigating who those auditors are? And invariably, it's easier to deal with the bigger, larger companies because they're dealing with more established third parties who are vouching for their information. Their information is they are accredited to big exchanges and so on. And the smaller, mid-tier type companies, more effort is required and more information is required, and they tend to get more no's from the banking industry, and they need to go maybe to a different tier service provider who can put in that additional required effort to get to understand them better.
No, that's interesting. Krishnan, are you coming up against the that sort of regulatory compliance issue?
Look, I
on
think
a daily basis?
regulatory compliance issues have been with us for the last 5 to 10 years, and I think everyone's been moving in that direction of travel. But the thing that I think is actually more interesting, and I think it's the thing that we would have talked about if Russia, hadn't occupied parts of Ukraine, is the increase in interest rates and how a higher interest rate environment may perversely remove some of the incentives for fraud, in particular in trade finance, that we've seen develop over the last 5 years, where we've had low growth economies and at the same time second and third tier finance providers were charging rates of 8 to 15%. And now we're seeing this flight to quality, and perversely I think that may make the underlying legitimacy of some of the business that is being financed a little bit easier.
Can I just make a comment? Flight to quality isn't always what you think it is. Most of the big frauds happened with well-known international banks who thought that documents were goods, and there are billions that were lost. And actually, if you're a small company, there is technology that means you can trace where your goods are at any one time.
About flight to quality is that, look, historically, in terms of headcount, most banks had much larger numbers of people, so they could spend much longer with their clients to understand their clients and understand what their client's business was really about and understand the risks involved in the client's trade. Unfortunately, there seems to have been a decrease in headcount, so it's much more difficult on a human level for the banks to make that assessment about what quality is and what quality isn't.
You're right, but some of that's down to the well-known Basel rules, where the cost of holding funds for trade has not been seen as worthwhile. So well-known international banks have retreated from trade finance, and that hasn't helped, which is where there are alternate funders.
Well, I mean, I think that part of it is the risk around it and frankly, the lack of digitization. So one of the things that we do is we provide a secure financing network to enable financier when they've financed an invoice, publish it to a common network, hash it out, fingerprint it, and then identify whether another bank has financed that. Also in India, we do things like authentication. We look into the tax network and make sure that the invoices that are being financed are actually filed. And again, none of it is a surefire bullet that you're going to stop the potential fraud, but it's another data point for your risk management people to make more informed decisions.
So provided the goods existed in the first place,
yeah,
they've only been financed once.
Well, and like in India, for instance, they have an e-way bill. So any physical shipment of goods anywhere across states, what have you, has to have an e-way bill. It's got a physical description of the goods, it's got carrier information, it's got the invoice details. So there are certain pockets of the world that are actually pretty far along on this in advance, but bringing that together globally is obviously a real challenge.
Right, I'm clock watching, and we're going to move on to the next question. Dheerie, specifically, actually, it ties in very well with what we've just been talking about, and that's that many commentators since the Singapore frauds, but even going back to Qingdao and all of the issues that arose there, have been really pinning their hopes on new technology, opening the way to sort of improved management, control of collateral, and that in turn would be a way to unlock funding for SMEs in particular, who find it very, very difficult to access them. And I think, both with bank and non-bank lending, that's been a problem. But what developments do you see coming forward, which is going to bring forward that promise?
Yeah, I think in the past, Rob, we've been speaking about it. Being a collateral management company, we physically undertake to have people in warehouses managing stock, etc., and then reporting just on paper, physical stock. But the inclination had always been to go and do something more electronic, more visual, and I think again it was further emphasized by the lack of movement of everybody during COVID, where this became a necessity. One of the ways or software that we looked at is out of the UK. It's a company called Surveyor Tech that enables us or our personnel in the warehouse to almost do a live stream reporting, or not almost, to do it, and thereby giving some sort of peace of mind to the financier that firstly his goods exist, that they exist there, time and place, not 2 months ago. And you can physically see that. And in certain cases where quantification is possible visually, they can even verify that.
And that linked in with what you described, Jesse, does give you both proof of existence and proof it's not double finance.
Yeah.
But Rupert, I wanted to ask you this question. Obviously, insurance is the glue that makes international trade work. We know that. Do you see this as an innovation which is going to change, either make insurers more willing to come forward and be involved in deals that they wouldn't have done otherwise? I can see the use of this kind of technology, for example, in big scale financings, particularly where there are borrowing base type facilities available. But what's your view on it?
The insurers want to take risk and they want to support trade. And I personally have been involved with Surveyor Tech and one other company, which is RVM. RVM is container monitoring. So what that means in real time, you can know where your container is. One of the headaches for an insurer is when it's paper-based, they don't know where things are. So what you can do with the technology is you can send an alarm out to the owner of the goods so they know what's happening, which is then verified. And what it means is, for example, if you're talking about cocoa out of West Africa, if it goes in a container, it can sweat, and you get a thing called container rain. That means when your cocoa arrives in destination, it has to be thrown out. But if you actually know what's happening en route, the underwriter, the insurer, knows that they may have a problem. They can ask somebody to deal with the problem, which reduces the cost. But importantly, on the supply chain, it also means that if you need to buy new goods, you can do that. And we've spoken to credit insurers who said, if you can tell us technologically there's a problem with that shipment, and you want to keep your customer, we're all here because customers buy these goods, then the insurers will support increased finance, which I'm sure the banks are happy to do, knowing that part of the loss is covered. So yes, it does work. It's a long answer to a short question. But we all work remotely, and what we've discovered is technology does work, and we've been forced to use it. And the insurance market is keen to support it, both on a cargo, a credit, and probably a political risk basis.
Rahul, I'd be interested to know your slant on this. Obviously, you're out in Côte d'Ivoire. Your business is the cocoa business. What extent are you seeing that technology put to good use, and has it changed, for example, the way that you're able to present risks, whether it's to financiers or to insurers?
So we are seeing in our case, we have an end-to-end we need to digitize our process as well. So basically, if there is a lot of to a farmer, it comes to country, gets processed processed, converts to liquid electricity. You can still tell you the entire plan and back to Europe or to US as to where it has landed. We have that kind of a tracing edge, which is what the other panelists were also discussing about. So we have that traceability across with us. At any given point of time, we can always find out which container is leaving where. And of course, when it lands, the quality has been determined at the landed scenario. So for us, definitely these things are a big boom when it comes to whether it is insurance or the cost of insurance as well as the cost of financing as well. But I think I was very concerned with the part that these technology or this digitalization is not something which I see into SMEs. They are able to get or probably invest a certain amount of money to get this kind of a facility or across. So for them, the cost of financing, the cost of premiums are still quite high. So I was quite interested to understand whether from the insurance experts or from the banking experts, that how can we probably reduce the cost for the SMEs, and which is where I was coming forward to, that can we probably shake hands in terms of the big trade houses, the bankers, the insurers, and then probably help to subsidize the cost for the SMEs. Otherwise, it will be difficult for them to get into the same mode as we are.
Good. Staying on technology, Krishnan, I want to come to you because I know you've got an opinion on most things, and I'm sure you have on this as well. But digitization in trade has seen so many false dawns, and I was first looking at this sort of 30 years ago. But during the last 12 months, you probably know Singapore has introduced a new law adopting essentially MELITA, an electronic documents law, which will make electronic bills of lading a legal reality. It's there in Singapore, provided, of course, everyone's working under Singaporean law at the moment. The UK is bringing in legislation during this year that will have an even greater impact. So that the digital train is really leaving the station now. It's been waved off. But how long will it take for this kind of legal change, from your point of view, to impact a market that's sort of coping with increased capital requirements and tightening margins?
So what we see is on the energy side of the business, there's been extremely enthusiastic adoption of digital technology. On the dry side of the business, so we move maybe 3 to 4 million tons of rice, mainly into West Africa, a smaller portion of sugar in bulk vessels. We basically haven't seen a meaningful push towards digitalization. It's something that we've always been very keen on. We've always believed that that is clearly the future. It will make everybody's life much easier, not just to minimize things like fraud, but just to be able to issue bills of lading correctly to the right parties without having to worry about DHL or FedExing things to Nouakchott or Niamey, right? And I think it really relies on the underlying banks to force traders and vessel owners to adopt it as a legal requirement for trade, because unfortunately inertia is the biggest enemy to progress.
I always say technology isn't the issue. The technology's there. It's been there for a long time.
Yeah.
It's the legal frameworks. It's getting the suppliers, the down chain people onto even just a digital platform, not even a common digital platform, but just getting it away from paper has been the big push. And I think you're absolutely right, Krishnan, that it's going to have to come from the financiers. The regulators can do a certain amount, but the financiers, the banks, what have you, they're the ones who have to start making these things a hard requirement.
So from your point of view, is the Singaporean and then the English law change a bit of a game changer in this? How far does it move?
Well, it definitely helps. The banks, the insurers, what have you, have comfort that they'll have legal recourse. So that's definitely a big step forward. We did India's first commercial paper issuance digitally just a few years ago. And the RBI called us in right away and said, "What did you guys do? How did it work? What digital signatures did you use? Was it legally binding?" And then once they walked through it and said, "That's amazing. Could you do this for bonds and CDs and things like that?" Because there is a big demand for this, and it really, like I say, technology isn't the issue. It's really how do you get the frameworks in place? How do you get all the market participants on either a common platform or at least being able to have their platforms talk?
And just sorry,
come back-
just on that, but on that, I think digitalization has to be genuine. So what we've seen in the past, in particular with things like tallies, people have promised like a digital tally, but actually what's occurring is there's a guy there with a notepad who's doing what he's basically been doing for the last 150 years, taking a physical tally with all of the problems with a physical tally involved. He then gives that physical tally, probably even faxes it to his regional office, and then they put it and upload it onto a platform. For me, that isn't a meaningful step forward to any kind of progress, because in reality, the guys who are doing the tally should be the ones who are putting it inputting it in directly.
Yeah. Yeah.
Stuart, are banks like Citi really focused and expecting something to happen soon, or are they all still seeing this as being 5-10 years down the track?
No, digital enhancement are real for banks. We are really very interested in the direction that it is going. There's been a lot of investment by banks because obviously there are a number of operators out there. Actually, there are too many operators with very good ideas, and I think the market is starting to move towards that one or two. We kind of got a beta or VHS kind of arrangement kind of going on, and we are moving into that area where 3 or 4 champions will emerge, and that will become mainstream. And a lot of the ones that I think are getting momentum are the ones where the interested parties are investors and equity holders. Not only do they trust the system, they are also part of it. You're getting a lot of traders and banks putting equity in operations such as Congo. You've got Contour out there. And those are independent channels through which documents can now be acceptable into the banking system. It's reducing, the risk of fraud, the risks of error, because the information is coming through trusted channels. And banks are now actually adjusting their systems to be able to receive this kind of information. And again, they cannot adjust the system to receive information from every single channel. So they're kind of settling on.
Well, I'm interested here, though, because I think one of the big things between all of the different platforms are out there, you've mentioned just a few of them, but until one of these eats the rest of them, there's going to be a continued divergence here. Is the answer that someone comes up with a way of providing interoperability between all of these different organizations so that, in fact, we don't have to wait for the last man standing?
I certainly think so, because it's always a question of, even financial institutions are developing their own systems. And we've got customers coming to us and saying, but I really don't want to connect to your system because now I'm married to you for life. I want to be able to deal with all my bankers. Can all my bankers join this one system that is non-bank linked?
So people will want to be able to multi-platform in the same way as they multi-bank. That is what will produce real competition, I guess.
It comes back to like what the ICC has been doing with the Digital Standards Initiative, right? So you don't necessarily have to have one monolithic platform to rule them all. The platforms do need to speak the same language. So common document formats, common, not to get too techie, JSONs and stuff like that, whereby you can have documents existing on Contour, and that could flow through to Comgo, or you could flow through to WeTrade or what have you. So it's really about how do you standardize what the APIs are, how they ultimately talk to each other. There might be a central connector, a messaging system. Swift could still play a role in that because they do the cover letters for EBLs, and these platforms might turn into more document management and workflow solutions versus necessarily being the complete end-to-end.
I think the question a lot of SMEs listening in on this want to know is, if all of this comes to pass and we have this digital miracle, is it going to turn the clock back to the point where big banks are still interested in SME business and are going to open their wallet to them, or are those days gone? Do you reckon this is going to be changing the game?
I think it will certainly improve the position. With regards to SMEs and so on, there are certain pathways in terms of which they can be serviced by the by the financing market. Large commercial banks do not necessarily have the reach to be able to assess and deal with SMEs, but they do have appetite, and there's a lot of focus actually on trying to make sure that funds do get to SMEs. Now it's a question of looking at some of and leveraging some of the enhancements in technology, where you've got platforms as well that are coming up in that area, things like Trade Information Network, which allows quality information to come through as to what SME is doing what in the market and how are they currently being helped. And then you have intermediaries between the big banks and the SMEs, and those intermediaries need liquidity. They can get liquidity from the big banks, they can get liquidity from the DFIs, but somebody has to operationalize this. I don't see a world where the big banks are now going to start lending cash directly to an SME, which is an institution, a company that they don't quite understand, but they're happy to work with somebody who is aggregating this risk, somebody who produces those 3 years of financials that we talked about in one of the panels, somebody who they can trust to manage it. And that particular party is able to deal with the SMEs, because the SMEs are not able to produce those three-year financials, but they can do what they need to do. And those institutions have different ways of assessing the risk. You've got the telcos coming into that space. They have a lot of data. They have different ways of assessing what the risk is relative to the bigger institutions.
Well, before I get more of the panel in, given that we're really pressing up on time, I want to give the audience a chance to put some questions. There are some mics out there. Yes.
Good afternoon. My name's Gabby Buck from GKB Ventures. I've got both an observation and a question, really. So my observation is that, and this is based on 35 years in banking. I was the chair of the British Bankers Association on export finance. I know this is a complex situation, and Rupert kind of more or less touched on this, but I think there's a big elephant in the room, and that hasn't been discussed, and that is that I believe that the banks are using the KYC due diligence and the regulation as a means of making sure that they don't take on any new customers. Banks are struggling, in my opinion, in terms of their leverage ratio, in terms of the Basel ruling, in terms of the capital that they have to allocate. And it's very easy for banks to say, actually, we can't take on another customer until you've gone through the new regulation of going through KYC, DD, which, it can be, and I've seen it, 6-7 months for a SME to go through that process. So that's my observation, and privately I've had bankers say that's the reason that we're doing this. We can't say we can't take people on, but it's very easy to say we can only take you on if you go through this huge treacle of a process. So that's my observation. The question is, do you believe I'm right?
Stewart, I think he meant you.
Look, as I mentioned just before you asked the question, right? There is appetite. People, particularly in Sub-Saharan Africa, people know that the SMEs are very important in driving supply chain. They're very important in providing the supplies that are required by the big industry, and equally as important when there are goods coming in by breaking the bulk. That big ship of rice that docks in Ghana needs to be broken down to baskets at the market. So SMEs are very crucial to this whole chain. It's about the efficiency and how you get the money to them. And, I think the bigger banks have a choice either to reconfigure and start looking at playing directly there, or continue to work with those intermediaries that I was talking about.
That's great. Krishnan, you wanted to add something in previously.
No, I think it was touching us on a point that Rupert made earlier, right? Which was, I don't think it's right to say just because somebody's 3-year financials or has been audited by the Big Four that we know that it's safe. Because if we look at the big bankruptcies that occurred in 2020, 2021, what we can say is all the bankruptcies that occurred where fraud was an integral part of the reason why they went bankrupt, all of them had been audited by the Big Four. And all of them had more than 3-year track record in financials. So it isn't a given that because you have those requirements or you meet those requirements that you're going to be a legitimate company. And I think it really comes down to the relationship that finances have between their understanding of the business, the underlying business, and their ability and their risk appetite.
Well, lunch is calling, Rupert, and I'm going to have to. I'm going to have to. Very quick.
So the technology is not expensive. The technology is available. If banks, as insurers, accept that you can use it, then there's no reason why there can't be more financing.
On that note, I'm going to thank our panelists. Thank you very much indeed. Rahul for joining us from Côte d'Ivoire. Many thanks, Rahul. Krishnan, Jesse, Dheerie, Rupert, Stewart, many thanks. And please go and enjoy lunch.